Today, I'm going to talk about the global rate cuts on the horizon. Fed and ECB weigh their next move amid softening labor market. Now, US employers added fewer jobs in August than anticipated, with payrolls increasing by 142,000 compared to the expected 164,000. Additionally, job groups for previous 2 months was revised downwards, with July's data adjusted from a 114 rise to just 89,000. So not only you need to see what is the latest data, you also need to understand the revision, because all this could be tricks, and if this is a sub 100K number, okay? So these trends add to growing evidence of a softening labor market, sparking debate about how aggressively the Federal Reserve should lower interest rates. Currently, the CME Fed Watch 2 indicates a 70% likelihood of a 25 basis point rate cut. Okay? Now, historically, the Federal Reserve has erred by acting too late to curb inflation, most notably during the early 1980s, which significantly eroded the purchasing power of Americans' households. A delay this time could risk increasing unemployment and potentially tipping the economy into recession. So this is one of the toughest things that the Fed needs to deal with. Okay, raise too late, it can tip the market into recession, it can hurt more jobs. This is something that they don't want to do, and Powell is trying to avoid. However, drawing on the Fed's previous actions, it's anticipated that any rate cuts will be gradual. We have not seen them going like super fast like that, as the central bank is cautious not to send mixed signals to the markets, especially given that overall economic activity is still doing fine. This we have to acknowledge. Overall, things are still okay. We are not seeing something really bad right now. Okay. Meanwhile, steadily declining gasoline prices are acting as a counterbalance against inflation. Retail gasoline prices in the US have dropped to a 6-month low and are expected to decrease further due to weaker than anticipated demand and a subdued outlook for crude oil use in motor fuels. As the economy, is doing well, but it's not doing that great. And when it's not doing that great, the demand for oil is also not there. So we are seeing that is coming down as well. So given the overall resilience of the US economy, the Fed still has opportunity to review 2 additional months' jobs reports following the September FOMC meeting before making further adjustments. They still have this luxury. So we have to wait. There are more data coming out to give us an idea what would be the preferable one. Right now, 25 basis points, we do expect that for September. So other than that, the European Central Bank is also likely to reduce interest rates on Thursday, potentially setting the stage for a US rate cut the following week as global monetary policy shifts towards more synchronized easing. Right? So since the ECB's last meeting, market participants have fully priced in another rate cut after September, most likely in December, with some speculating about an October cut. But right now, I think it's probably September and December, based on what Lagarde has said. However, ECB policymakers have not yet endorsed consecutive rate decisions. This is all speculation. So right now, September, and probably another one in December, we shall see. Now, a recent Reuters poll found that nearly 85% of economists, which is 64 out of 77, anticipate that ECB will lower the deposit rate by 25 basis points next week, and again in December, bringing deposit rate down to 3.25%. This decision is likely driven by the slowdown in wages and weak economic activity. So this is one other things that we need to look at for the European data. Okay, so if we see wages is holding steady, then this probability might change. Okay, so this is important news for the euro as well. So looking ahead, ECB policymakers remain divided over the persistent inflationary pressures, which the bank targets at 2%, and the broader economic slowdown, suggesting that future policy decisions could be increasingly complex and fraught with uncertainty. And this is also the reason why that you're seeing a clearer trend on the euro dollar than anything else in the, because it's just like the Federal Reserve, they are, more or less the market expect them to say cut, cut, cut. So they're going to have 3 cuts: September, November, December. When it comes to the ECB, it's a totally different thing. They know that yes, probably they're going to have 1 cut in the September, but the following months of November, not sure. December, probably. Okay, so this not sure versus something that even Powell has said, yeah, it's come to that time where they have to reduce. So this is a sure thing. And when you have that, that's the reason why you see the euro dollar move in that way, where there's a bullish movement towards the euro dollar. Okay, so with that, that's the report for today.